Did you know investors act safe when it comes to profits, but gamble when it comes to avoiding losses? It's not just numbers, it's psychology. Welcome to Prospect Theory, how we see gains and losses. Let me show you what I mean. Picture this. You're an everyday investor, staring at your investment chart. Suddenly, you have two money options. Option A guaranteed profit of $50,000. Option B, a 50% chance to gain $100,000 or walk away with nothing. What would you choose? A guaranteed $50,000 or a 50% chance of getting $100,000? Even though the expected value of both options is the same, yet most people, maybe even you, smile and pick the safe $50,000. When choices are framed as profits, we prefer certainty. This is called risk aversion. But let's flip the script. Option C, a guaranteed loss of $50,000. Option D, a 50% chance to lose $100,000 or lose nothing at all. Suddenly, the investor frowns and decides to gamble, rolling the dice for a shot at avoiding the loss. This isn't just theory, you see it every day in the markets. Many investors sell their winning stocks too quickly, locking in small profits because certainty feels good. That's risk aversion with gains. But when a stock starts falling, the same investors often hold on, hoping it will bounce back, rather than accepting a sure loss. That's risk-seeking with losses. This behavior is so common, it even has a name, the disposition effect. During market bubbles, like the dot-com boom, many investors held on to falling stocks, hoping to avoid realizing losses, even while safer opportunities were available. This is risk-seeking, taking chances to avoid a sure loss. But why do we act this way? The roots go back to human survival. Imagine our ancestors. If they found a little food, the safe choice was to keep it and avoid risk. That's like risk aversion with gains. But if they faced hunger and the choice was a sure loss or a risky hunt, many would gamble for a chance at survival. That's risk-seeking with losses. Our brains still carry these instincts, even in today's financial decisions. So, what's really going on here? This is where prospect theory steps in. Imagine a balanced scale, gains, losses, but the loss side is heavier. According to prospect theory, losses loom larger than equivalent gains. Losing $50,000 hurts more than gaining $50,000 feels good. This is called loss aversion. But there's another twist, your reference point. Picture two investors standing at a spot labeled status quo. Arrows point up to gains, arrows point down to losses. What really matters is where you're starting from. People measure outcomes relative to their current situation. That's why the same decision can feel safe in one frame and risky in another. Reference point = current situation. So what does this mean for you as an investor? First, pause before reacting emotionally to gains or losses. Remember that losses feel bigger than they really are, and this can push you into risky decisions. Second, try reframing situations. Instead of thinking, I lost $50,000, think of it as, I still have $50,000 left to grow. Third, focus on long-term goals and diversification. The more balanced your portfolio, the less likely emotions will drive your choices. In short, don't let framing trick you, let strategy guide you. Think of investing like a seesaw. Gains tilt you toward caution, making you risk-averse, while losses tilt you toward risk-taking, making you gamble to avoid pain. Understanding this tilt, how gains and losses affect our decisions, can help us balance our choices and make smarter financial moves. Let's tie it all together. The way a choice is framed, profit or loss. Gains make us risk-averse, losses make us risk-seeking, and the framing effect? It's the lens that changes everything. So next time you're making a financial decision, remember, it's not just about the numbers, it's about how your mind frames the choice. Understanding these biases can help you make smarter, calmer investment decisions. Thanks for watching.